Welcome options traders, and this is another Facebook trading tutorial, and I'm calling this, Why Did My Option Lose Money? Because I hear this question a lot from traders, especially during earnings season, when you get a lot of people who like to speculate on earnings. And I've never been a big fan of speculating on earnings for a variety of reasons, and what I'm about to show you here is probably the key reason. But you do find people who like to do it, and they're always left scratching their heads going, how come I was correct about the direction of the stock, but my option lost money? So let's take a look at that, and then we'll also find out some ways you can reduce the chances of this happening. Now, as you probably remember, NVIDIA came out with earnings on May 11th last week. So here we are the day before, on May 10th, on Thursday, 3:45 p.m. So we've got 15 minutes to buy our option prior to the closing bell, getting ready for earnings tomorrow. And a lot of traders use this as a strategy, and they'll say, well, I don't want to buy it a week ago or 2 weeks ago and have all this time decay affecting my option. I'm going to wait as close as I can to earnings, and then I'll buy this option. And if the stock moves in my direction, I'll make a ton of money. It's an optimal strategy. Well, it seems obvious, but it's wrong. So to make things worse, they'll look at the one-day option right here. Again, why pay for extra time? So here's the setup. NVIDIA is trading for $259.73, again, 15 minutes before the closing bell. And they'll look at this column over here, which is the mark. That's the halfway point or the midpoint between the bid and the ask. And in most cases, that's where you can get those various strikes filled. And they'll start down here and say, I don't want to pay 12, 10, 9, $5.85 looks pretty good. Most people know they don't want to buy the little 10-cent options, but they'll start picking a price in here that seems like a reasonable bet for them. And most of the time, they're just trying to minimize the amount that they can lose. And that's really the wrong way to approach it. But let's just say that the person buys the 255 strike, and it was trading for 585. Now notice over here, this option has no intrinsic value. That means that the stock price is currently above 255. It's not going to have any intrinsic value unless that stock falls below 255. We've only got a day for that to happen. All of this option's price is extrinsic value or time value. It's due to the fact that time still remains, not a lot, but time still remains on the option. Another interesting fact you have to understand, this column all becomes zeros at expiration. That is a mathematical fact. All time value goes to zero at expiration. Why? Because there's no time left. So, as I've said in previous videos, options are a race against time. Yes, it's possible that this column right here could start building intrinsic value if the stock falls below 255, but it's also going to be subtracting value off of the extrinsic value column. So we have to get the stock to move quickly and aggressively before we're going to make money. Now, another little trick you can do is to come over here to this column that says theta. Theta is one of the many Greeks that are mathematical sensitivity measures to an option. And I'm going to start doing some Greek week here. We'll talk about some Greeks in future videos here. But theta, think of Greek letter T, theta, stands for time. So this 255 put has a theta of $3.74. And what that means is that with 1 day's passage of time, this option is going to lose $3.74. Well, guess what? We've only got 1 day to go. So of this 585, $3.74 is coming off right off the bat. Let's say we bought that option for $5.85, opening bell the next day. Now, these quotes were shot right on the opening bell. And look at this, $254.53. The stock is trading down $5.60. So new traders are thinking, hey, this is great. I paid $5.85. The stock has now taken another big hit, more than 2%. This option should be worth a ton of money. They come down here and they look and they go, what? 70 cents? How is that possible? Why was my option worth $5.85 yesterday? I paid my money. I was correct that the stock was going to fall, and I lose virtually all of it? What's going on here? Well, let's take a look at what the contract tells us. The contract gives you the right to sell shares for $255. Yesterday, nobody knew where the stock was going to be. So they were willing to pay a lot of extrinsic value. On the opening bell, cat's out of the bag. We know where the stock is, and we know it's probably going to be sitting there most of the day. And because there's only one day left, how much would you be willing to pay for the remaining amount of time? Well, probably not much. And in fact, you can see the extrinsic value right here was 23 cents. Yes, yesterday it was $5.85. Today it's 23 cents. We did pick up 47 cents of intrinsic value. Big deal. Not anywhere near enough to offset that $5.85 cost. So the options price is 70 cents, 47 cents is intrinsic, 23 cents is time. We can break that options price down into those two component parts. And so now we see that because we are at expiration and the stock's at 254.5, people are saying, I don't really know if I want the 255 put. I think it's probably going to be worth about 50 cents. They're not willing to pay a lot for it. So the mistake that new traders make is they always look at options as almost like a lottery ticket. I'm going to pay $5.85 for my ticket, and if the stock price falls, I make money. Absolutely dead wrong. It's a race against time. That $5.85 is moving towards zero quickly, and what you're hoping for is that that intrinsic value is moving past $5.85 faster. You have to build the intrinsic at a faster rate than what the extrinsic value is losing. And again, right here, we picked up 47 cents of intrinsic, but we lost virtually all of our extrinsic. And that's why the option's only trading for 70 cents. So the point to understand is that you have to remember that options are two-dimensional assets. And I've made this point before in previous videos. And what I mean by this, technically they're multidimensional, but at a very simplistic level, they are two-dimensional. And if you are trading shares of stock, you only have to come up with one decision. Is the stock price going up or is it going down? That's one dimension. If you think the price is moving higher, buy the shares. You think it's going down, short the shares, and you'll make dollar for dollar up or down if you're correct. It's a one-dimensional asset. Most people who come into the options market came from a stock trading background and they carry the same mentality into the options market, and you cannot do that. Not only do you have to be correct about the direction of the stock for the option, but let's say we had a $100 call option here, you also have to be correct about the speed. Is it going to be a slow grinding move, or is it going to be fast and aggressive? And depending on your answer, that's going to dictate how much extrinsic value we can use and also help to determine which strategy is best. So we can see the speed component by looking at the break-even price. For put options, you will subtract the options price from your strike. So if we take the 255 strike, subtract off the 585 cost, we get a price of 249.15. And what that means is that at expiration, the stock must move from its current price of 259.73 down to my break-even of 249.15, or a loss of 4%, just to get my money back. That's why there's a speed component. Notice if we were stock traders and we shorted shares at 259.73 and it fell down to 249.15, we would make 4% on our money. We're just going to break even with the option. There's a speed component. So option traders need the stock price to move fast and aggressively in order to make money. So how can you solve this problem? Well, this is where option strategies come in. There's a lot of different things to look at and to consider, but let me just show you a simple way. Let's back up to Thursday at 3:45 p.m. If we think the stock price is going to fall, but we're not sure how quickly, then don't play the speed game. Keep the extrinsic value low. That break-even point is coming from the extrinsic value. So take a look at what happens down here. I can go in the money. I could buy an in-the-money put option. Yes, I got to pay a lot of intrinsic value. But as I go in the money, interestingly, mathematically, the extrinsic value must fall. And I could choose a lot of different strikes. But just let's say that I bought this one down here at the bottom, the 277.50 strike. And it was trading for about 1957, 1958 on the mark. What would have happened on tomorrow's opening bell? Well, you can see it was trading for 23 and change. It did make money, and in fact, it made almost the same dollar amount that the stock price fell. Why? Because it was heavy with intrinsic value and very light on extrinsic value. And because it was light on extrinsic value, I don't need the stock price to make this fast, aggressive move. Unfortunately, new options traders don't see it that way. They love to use these out-of-the-money options thinking that put option's a put option, they're all going to make money if the stock price falls. That's not true. And so they like to buy these cheap options thinking that they can minimize their losses. That part is true, but you've also got almost no chance for any profit. You've virtually just guaranteed the loss of your money. So when you're trading options, start thinking about two dimensions. Up, down, that's one choice, but also, is it going to be fast or slow? And if you don't really have an opinion on whether it's going to be fast or slow, stick with an in-the-money option. And that's where the art and science of options trading and strategies will help you to succeed. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsa2z.com. You can also instant message me here on Facebook.